Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day, and today's episode is sponsored by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. And today we have a guest to talk about uranium. It's been a while since we discussed that on the show, and there is nobody better to do that with than Mike Alkin. He is the Chief Investment Officer of the nuclear power and uranium-focused hedge fund, Sachem Cove Partners. Mike, it's great to have you back on the show.
Hey, Jesse. Thanks for having me. Good to see you.
I wanted to start with a bit of a year in review for the uranium sector in 2023. What went the way that you thought it would? Did anything surprise you? And more importantly, how did the events that transpired in the uranium market in 2023, how will that influence your view of the market and perhaps your investment decisions moving forward into the new year?
Yeah, it's a good question, Jess. Last year, 2022, the market was down and uranium stocks were down, but not too badly compared to the overall broader market. And in an odd way, that I was pleased to see that because these are tiny, many of them, not all, but many of them are tiny micro cap, small cap companies that, in a very risk off environment like you saw in 22, can easily kind of get thrown out a little bit, right? That didn't really occur. They were down, right, but it wasn't crazy. 23, has played out from the ETFs are up strongly, right? So you're seeing uranium price, the price of physical uranium is up significantly. That doesn't surprise me that physical uranium is higher because, I sound like a broken record. That's why I don't do a lot of these anymore, because what am I going to say, right? Since 2017 that we think the price is moving a lot higher. I'm sick of, when I'm doing these interviews, I'm sick of hearing myself sometimes. That's why I do a lot less of them, because I don't have anything really different to add other than what our thesis is. So is 23 surprising? The price of physical? No. The equities are sometimes a mystery. You don't know how they're going to trade. You don't know how sentiment is going to take over. And sometimes sentiment is week to week and month to month. And it could be somebody just had a comment somewhere, or there's a macro rotation and you're seeing something, which happens in all sectors. But the sentiment on the equities is trickier than the physical, but eventually they catch up because people will chase. So this year, I think it's been a strong year on the equities, a really strong year on the physical. Am I surprised? Not surprised by the supply demand driving uranium higher. The equities sometimes are a mystery, but eventually they do get there.
Yeah, you mentioned the price of physical uranium rising. It's now at a 15-year high. When it comes to the spot price specifically, where do you see the price action going from here? Obviously, there's that's a bit of a not specific enough of a question, but more importantly, I wonder if you could let us know how important is the spot price for your average investor to be paying attention to? Because on Twitter, people rejoice when the spot price is high, but there's also the term market, which I think you've said is more important before, which is more opaque, and those price levels are not so accessible to your average investors. So how should retail investors be looking at the spot price?
It's a superb question. I also think the retail investor is not that much different than the institutional investor in terms of psychology, right? Maybe the institutional investor has more tools and more time, and maybe more experience in doing it, but that shouldn't shortchange the retail investor. Right. It's one person who does it all the time, one person who's doing it in their spare time, maybe. That said, when there is a market as opaque and complicated as uranium and the nuclear power market, the fuel cycle, right? You look for any piece of information or any data point that can give you some sort of a guide. Right, think about the fuel cycle. mine it, crush it into yellow cake, convert it into UF6, enrich it, and then put it in fabricated fuel rods. You can go in. That's a lot, right? A couple of years worth of stuff, time. Um, Along the way, what really the only part that an investor sees is the price reporters putting out a spot price on a daily basis, right? There's a futures contract that is it's completely inconsequential. It's too small. It doesn't do anything. There's no participants really. When I say no, there's a couple, but it's not meaningful. So the spot price is what people look at. Price reporter comes out and they post it at the end of the day. Maybe during the day they'll update it if somebody looks and gets the app, but it's archaic. It's not necessarily real time. So, but it's not only so. So what happens, right? When people get a sniff of what that price is on a given day, the stocks can sometimes move or not. But it's important to understand the role of spot in the market, right? So think about both sides of this equation. Nuclear reactors are long-lived assets. Uranium mines are long-lived assets. Over time, 85% of uranium over many cycles trades under long-term contracts, 6, 7, 8, 10, 12 years, right? That's where most of it trades. When there are periods of excess, then the spot market becomes an excess disposal place, and you might see more. You might see half of the market trade there, but that's temporary. Over a period of what are we looking at? 50 years of this stuff. You're talking for a few years, you might see that spot market be more meaningful. That said, it drives psychology, but for retail institutions, we get calls. We've been around this space for a long time now. When hedge funds and mutual funds want to get up to speed, we'll get inbounds. When news breaks, we get inbounds. Hey, what are you thinking about this? Fuel buyers, their bosses. It's structured that way, right? So, and I'm getting long-winded here, and I apologize, but it's really important to understand, I think, the context of which we're talking about. So you have an indicator. And remember, Jesse, the spot price doesn't necessarily mean that's where it traded that day, right? So when you think about another spot price of all these commodities that are out there, it's what changes hands like that, right? This is what the price reporter will calculate is what is going to be delivered in the next 3 months. It could go out as far as a year, technically, is what the spot price would be. That's not a spot price. You're starting to get into a futures market. It's not what changed at hand overnight. We buy physical uranium. I can tell you there are days I don't get an offer on it. So if I wanted it in 1 month, I can't get it. So but what winds up happening is, so you have an infrequent, you have a supposedly daily indicator in a part of the market that on its best day and year is not even is maybe half the market, a little bit more, a little bit less, but mostly it's not. But that drives sentiment because it's the only available indicator. And as you said, it's opaque. Long-term contracts are opaque unless you're doing your due diligence and talking to people throughout the fuel cycle. So spot price, while long-term contracts, production economics, I want to sell you uranium over a 7, 8, 10-year period. Here's the price that I require. It might be very different than spot price. You might need to pay more. That fuel buyer, and this we have firsthand knowledge of. I was for years, and I was presenting to the Nuclear Energy Institute annual conferences. They represent the U.S. fuel buyers and the utilities in Congress in 2018, 2019, and talking to them and explaining to them why we thought prices had to go higher. And these are really smart people, but they're not. The structure isn't such that it's a small portion of what they buy. They just need a secure supply. They'll pay what they need to pay, whether it's low or high. And that's different from a commercial creature trying to understand that. But if you're a fuel buyer and you're going into your boss, and this was, and I'll tell you something real quick, this is what triggered me to start the fund in 2017, when I started it in 18, was when I was meeting with utility buyers at a nuclear fuel conference. I had dinner with several of them. And it was talking about the prices of uranium and what drives the prices, and would you buy low? There's shortages that are coming up. They're like, we're going to pay what we pay when we think we need to pay it, and there's no incentive to do differently. When we're not going to try and buy low, we're gonna when it starts moving higher, that tells them other people are looking, and then they'll start to pay attention. So, very long-winded of saying, the spot price does inform the market's view of supply and demand. We think at times, especially earlier on when it was 30 and 40 and 20 and 18, when we were looking at stuff, is now 82 for comparison. It's misleading, but it is the indicator. It's what enables a fuel buyer to walk into his chief nuclear officer and say prices are rising. It's spot price. It's now the now the bellwether price reporters and forecasters are just putting out a note saying, about spot price at 80 and could go much higher. We think it goes higher rather than a lot better chance to go higher than lower. So yeah, spot price is that indicator that people pay attention to. Now, today, you're seeing this, it's shifted. It's gone from a buyer's market to a seller's market. And so when there are utilities that are trying to secure, and if you're trying to get to some of the big contract producers, they're going to tell you 2027, I can start delivering, right? A few years ago, they would have said, okay, what do you need? But the price is higher, but what do you need? So the supply and demand in the long-term contract is really tight, which means prices are going higher. Now, interestingly, this transition, Jesse, is to understand the fuel cycle. The long-term contract today is lower than the spot price, right? So if the spot price is 82, you're looking out, you start to go 3-year and 5-year, which is not technically considered long-term, is you start to get into the high 70s, low 80s. The term price is still in the mid 60s, right? So what does that mean? Because does it trigger something? What producers want to do right now, if I'm a producer and I see supply demand, I want to go from doing a base escalated price, which they've been doing for years now because they've had to. We'll sell to you at this price and we'll escalate a few percent a year. They take what they got. Now they're saying we want market related prices. So we'll start delivering to you in 3, 4, 5 years, right? But we want it at time of delivery. And then we'll take a floor and we want ceiling. We'll give you a ceiling, but that ceiling could have a triple digit number on it. So they're willing to not set a base price now. It's what they want to do. And so the price reporters don't capture that. There's a lot less base contracting taking place. And so they're working off of, I would say, not the meaningful part of the market. So spot is a psychological indicator. Spot will play a role in how investors think and fuel buyers think. And that, here we are. We're $82. Long-term contracting is accelerating significantly. In 2021, there were 70 million pounds contracted. In 2022, there were 114 million pounds. There's 156 million pounds contracted thus far this year in the first week of December, through the first week of December. Our demand numbers, if they use consensus demand numbers, which we think are low, 180, 190. In past cycles, when you see it really take off, you get to as high as 130, 140% of annual demand being contracted for. And we think you're right there. We think spot, which, spot does play a role in the psychology, but it's giving way now to term contracting where it's driving that psychology, making it easier. But man, it's turned into now a contracting game. But again, I don't know a way for people to ignore spot, right? It's part of the fiber of the industry.
So before we hit record, you were saying that in 2017, you were saying the horse left the barn for this uranium bull market. I'm wondering how investors should think about the timing of it, because obviously the last one pre-Fukushima, there was a parabolic spike and then collapse in the price. And there's different schools of thought when it comes to timing one's investments. There's dollar cost averaging, timing the market versus time in the market. And there's those who say, no, you should keep cash on the sidelines and you should wait for dips. Now, there's pluses and minuses to both approaches, I suppose, but I'm wondering how you personally approach it. Are you just is your fund just investing regularly? Are you waiting for price pullbacks? And how do you see the timing of this bull market going? Is it a matter of like you need to accumulate because there could be a parabolic spike, or do you think it'll be longer and more protracted and people will have time?
The supply demand is such that if history teaches everything in investing. If you don't know the past, it's hard to know the present and what that means for the future. So I spend and my guys, we spend a significant amount of time before we even began what we do, studying the past and trying to see in deeply cyclical industries. The past can inform not predict it, but give you insight into the future, where are the parallels, where are the differences. So in the past cycle, from 1994 to 2004, there was a significant amount of inventory. There was contracting was not at replacement rate, meaning a pound is used. Do you replace it with a pound on an annual basis? No, they were doing a third of a pound. And that was for a long time. Inventories were being sucked down. But the price until 2005 that happened. So early 90s, you're talking a decade. Then you started to see, but the price was $7 in 2000 at the end of the year, roughly. And then by the end of 2005, roughly, you're in the low 40s, and then people attribute the reason for the last spike was because Cigar Lake mine flooded before it was scheduled to open. People say, oh, that's the reason it was. But by that time, prices had already risen 7x. So from 2000 to 2006, in October when it flooded, it was a 7x increase. And what was happening? Inventory is being drawn down. So let's think about here. Prices, so that was 7x. And back at that period, there were a couple of things going on. What was the environment like at the time? Inventories at the utilities were a little bit sub 2 years, but inventories at the traders and producers were higher. There was a massive off-balance sheet asset, if you will. It's not the technical term, but it's kind of what was happening was, as you know, back then from 93 to 2013, there was a program called Megatons to Megawatts. Russian down-blended missiles with nuclear fuel down to civilian nuclear fuel, send it in. It came to the U.S. It was 20 million, roughly, pounds every year out of 50 million. So if you're a fuel buyer, you didn't have to worry about it. You knew it was coming in, right? So it's not like, where am I going to get pounds? They kind of knew that was coming. And then back then, you also had Kazakhstan, which was an insignificant producer. They were just ramping, right? So if you look at 05 to 15 forecasts in 05, Kazakhstan was supposed to go from 9 million to 19 million pounds. They wound up going 9 million to, by like 2013 or so, or 14, 56 million pounds. So there was incremental pounds coming into the market at a very rapid clip, right? So what happened? So a flood comes at Cigar Lake and people say, oh, prices went crazy because it didn't open up in 07. Like I said, by that time, the price was up 7x. But again, you have to understand what are the people, what were market participants, what was the information they had at hand at the time. And at that time, if you looked at forecasting, it would have told you, if you were a fuel buyer looking to buy out into the future, I'm going to secure a long-term contract because stuff is happening. The market, right? There's a flood coming. Well, if I was a fuel buyer and I sat and looked at that before the flood in October of 06, where it was obvious the mine wouldn't come on for years, and I was looking out and I buy in 6, 7, 8, 9, 10, 12 years, if I took a minimum of that 6 years and I looked out and I said, how much uranium is out there over those next 6 years? There was 125 million pound surplus according to forecasts. The flood comes along, and then when the forecast started getting updated, when in the first quarter of '07, and people started understanding this mine wasn't coming online for years, that was scheduled to open in '07. I'm that fuel buyer, and I now look at the new forecast, and there's 225 million pounds of surplus. So the biggest mine in the world is scheduled to come online. It gets flooded. It's not coming online for years. The updated forecasts show almost double the amount of supply. What happened? Well, the forecasters found some extra mines that they thought would come online. Demand dropped a little bit. Whatever they did, whatever magic was there. And so what wound up, but the price of uranium then by that time was in January in '07, the price was in the low 60s. And then during '06 and '07, it spiked up to, at one brief time, 137. But contracts were being signed at $90, $95 in the ballpark. So that I have to study. And we studied it, and we still study it, and we go back and revisit it all the time, right? What are the similarities? What are the differences to today? Today, contracting shut down, not completely, but slowed down after Fukushima in March of 2011. So 2012, there was actually a reasonable contracting year. The market didn't think then that Japan would shut down all those reactors like they did. But 2013, 14, 15, 16, 17, 18, 19, 20, you were looking at a replacement rate of about 35, 6, 7%. So not quite the 1/3, but nowhere near replacing it. So what were they doing? They were drawing down inventories, pulling them down, very similar to the last cycle. The price had gotten down to $17 or $18 at a low in November of 16. And then, so contracting inventories are being sucked down. And there were some reports in the market at that time that there were 1.4, 1.5, 1.6, 1.7 billion pounds of inventory out there. Use a number of 180 at that time. So people are looking, saying, oh, there's almost 10 years of inventory. The average utility wants 2 to 3 years. Okay, so you look at the composition of that inventory, and it was clear to us that people were just accumulating all the inventories. They weren't accounting for the mobile inventories. What's accessible? What's economical? Right? You got to be a commercial creature. When you think about this stuff, to us, it was very clear there's 3 or 4 years of inventory. Maybe a drop more, but not 10. And then what else? What was there then that is not available today? Well, Kazakhstan, right, today is the largest producer in the world. Combined with their own production at joint ventures, they produce 41%, give or take, global supply. They had cut production or in 2017. But the rate of change of them bringing on, increasing that production level is de minimis compared to the last cycle at the rate of change that they were bringing it on and what was expected in the market. It's not a mystery. So why they're going to bring on some more pounds? It doesn't solve the deficits. That's the first thing. The second thing, the big, is there's no megatons to megawatts. That's not there. So there's no 20 million pounds a year coming into the market. So you have inventory levels now that are below historical averages. And even a couple of years ago, they were there. They were getting there, but they were not stretched at all. And you don't have those two big things in the market. There's no new big mine supply coming online. There's one big mine that could come online in the late 20s. It's a long time away. So that's the most important thing, is understanding the history. How that informs us is, I personally believe that in your career or in investing, there's very few good ideas, really good marginal idea where you can hopefully generate real alpha. It's hard to find, right? Markets are mostly efficient, but I don't think they're totally efficient. And I think that efficient market theory doesn't apply. In some markets maybe, but in some markets it doesn't. In opaque markets, I don't think it does. So I think for me, my view is when you see opportunities like that come along infrequently, you make a bet. Um, that's kind of what I did in 2018, 2016, 17, doing the work. 2018 realized that I need to express the view doing that, um, and and then how do we do that now? Dollar cost average, all that stuff. You ask those questions. Um, you know, um, it's tricky, right? Because mining's a tough business, right? We mostly do uranium. We buy physical uranium. Um, Physical uranium, I don't have to worry about a promotional management team diluting me. It might go down or up in a given period. I think a long time ago, it's going way higher. Um, you don't get the torque sometimes on a big move up when people get really excited. But people have to decide whether you like that trade off or not. And then once in the industry, the way I kind of view it, once we I determine that you're going to make the bet, you're already making a bet on a sector. And then it's surveying the landscape, right? And again, mining is tricky. Junior mining is really tricky. As things start working, more companies come into the sector, and more promotional. And so, you asked me what we look at, right? We've been around the sector we've been very vocal since 2017. I have been out publicly laying out a thesis. I get sick of hearing myself talk about it. That's why I don't talk a lot anymore. There's very little to say. And when I say that, time is your best ally. So you don't see me doing a lot of these. I never am on Twitter anymore because there's nothing to say. The thesis is playing out. From an investment standpoint, that attracts people. So you have to be careful. As more people come into the sector, you see more CEOs. It attracts more media attention. It attracts more people who are going to create businesses around it. It creates more companies. So now you're talking with teams, management teams that may know very little about the actual commodity or the history of it, and what they want to do is just be part of a rising boat. And so management's really important. When we do an introductory call, probably in the first 10 minutes, I could tell A, if they know the history of the industry, B, if they know the landscape, and if they don't, be polite and shut the call down pretty quickly. Give them 10 more minutes to tell me about 20 minutes what they're doing. I keep cash around because of the opaqueness of the industry, because sentiment changes so quickly, right? I'm very comfortable having a little bit of cash around to take advantage of that. I in these type of sectors, I wouldn't leverage something. So you keep a little cash around for those rainy days, not fundamentally, but for sentiment wise, and maybe sometimes. And being a sector bet, it's already concentrated, and then within that, I do concentrate. I think, I'm okay with taking smaller positions. When companies do capital raises, if there's a reasonable chance, I'm a supporter of the industry. It doesn't mean I have to make a big bet on them, right? I prefer quality to the best I can. Quality management, quality deposits versus pure spec. They're all speculation to some degree. You're speculating on the price of a commodity ultimately. But there's, look, I think as people think, there's a place maybe for some people for, little buckets within however they're thinking about it. You could have way more speculation than something else. I I don't like to really, we don't talk about it or the investments we make because I have no idea what people's risk tolerances are, how they view it, how much work they're putting into it. And the last thing I want to do is tell anyone what to do. I just know what we do. So, it's yeah, but yes, good question. Cash is something that's not, in my view, I think cash is a good thing. But we have significant. Oh, we're mostly invested, and I could just say that from my perspective, like for instance, just recently adding more to my view of it, and I got to be careful how I word things, right? Because there's, I can't. I'm only allowed to say certain things.
Yeah, that makes perfect sense. I wanted to follow up on that in terms of having a strategy to exit positions because different people approach this in different ways. Um, and people on social media have visions of sugar plums dancing in their head when it comes to the uranium industry, especially on uranium Twitter, dreaming of their 10-bagger riches that are coming to them. But rarely do people have any sort of idea of when they should sell. You see certain people saying, a great way to lose out on a 10-bagger is to sell on a double. Well, maybe it's okay to sell on a double. It really depends on the situation. So, how do you think the best way to approach that is? And again, not speaking about what you're necessarily doing, but how maybe a retail investor should be thinking about, should they be scaling out of positions? And again, we want to be careful here. Nothing here is investment advice. You don't want to tell people what to do, but how can people wrap their heads around that at exiting a position and kind of knowing when it might be prudent to take some profits off the table?
Yeah, I was very fortunate or very early in my career, I worked for a legendary hedge fund manager, and I remember it was very early in my career, and as you get all these new bells and whistle toys, you get all these great machines and technology and all this stuff. Even way back when there was some stuff, and when I would look at a company, I would look at all the fundamentals, and I look at the chart, and if the chart was up a lot, I'd be like, oh, geez, boy, maybe we missed that. I didn't know. I was new. I was green, and I was talking to him one day, and he said, like, the stock doesn't know where it came from, right? The stock has no memory. The stock doesn't know. You worry about the fundamentals going into the future. I don't care if it's up 10x, 20x, 30x, whatever it might be. Today's a new day. You're analyzing it today for the first time. The fundamentals is, where does it sit valuation wise, right? What's the art and science? What are the fundamentals? What's the valuation? And then where is it in people's thought? Is it a theme that's starting to emerge? It's just beginning, or whatever it might be. So you got to marry the art and the science. So I don't really care if a stock has been up X amount. I care where I think it's going. So I like for in uranium, I can only say that I'm committing more capital to it. I think we're early days, which people would say, oh, that's crazy. I get inbounds from people saying, should you be taking money off the table here? Should you be doing this? Should you be doing that? The industry sector prices have had a good move, and people get nervous. And that everyone's different, right? To somebody, this might be it might have been the trade of a lifetime, and then it's time to take it off, right? I don't know. And that's why I don't really talk about that. I only talk about what I think is interesting. Is from a fundamental standpoint, and where the art portion of it is. So from my perspective, for me, and my business partner, and how we think about our things is, I think the fundamentals are just starting to play out as we thought they would, and it's starting to get reflected. And I think that things stay down longer than they should, and then things, by the time it takes longer for people to recognize they're changing, and then they stay up for a long time. But it's all driven, to me, based on the fundamentals, right? Price is what you pay, value is what you get. I love the value.
Well, let's now enter a fantasy world where Mike Alkin is not aware of every uranium company that is out there and has not been carefully researching all of them. A new uranium company crosses your desk. What are the main things you're looking at to determine whether this is an investable company or not? You mentioned management earlier. Obviously, that's very important. What other factors do you look at?
I look at right there where they are, what part of the world. I don't necessarily run away from anything because it's in part of the world. It depends on how that's priced. It could be in a really tough neighborhood, in a mining jurisdiction that's really tricky. But it might be something where I look at the valuation and say, if I were to make an investment here, am I basically buying a call option on something that works? And then it might inform how I say, you know what, I might say, okay, this is really tricky. It might not be, it's something that has a probability of maybe not working because of the geographic, whatever the situation is. But if it does work, I have X amount of upside. And then that's what's, if it does work, I have X amount of upside. If it doesn't, where do I think it goes? If I think the reward is meaningfully higher than the risk, then I size it appropriately. You know, it could be a very tiny position in my mind, or it could be I just size that. But it's in my mind. I'm like, okay, if I woke up one day and I was wrong and I lost half or three quarters of it, or maybe the whole thing, could I live with that? Yeah, okay. But if it's right, could it go up many multiples? Then I'll think about that. So what I try not to do is have a set. But I mean, I've made so many mistakes in my investing career, right? I mean, I can't even, that's how you learn, right? And so what you learn is to be malleable and to be flexible, to understand the situation and not put myself in a box. So that's the first thing I look at it and I say, okay, where is it geographic? What's the management's background? Do they have, in this case, uranium background? Were they tourists? Were they going from commodity to commodity to commodity? That to me is way more is a big red flag. Um, and then we'll so where is it? What's the valuation on where it is? Is it something that I would consider? I'll read a presentation. Um, I'll go. I might find a couple of interviews where they were interviewed. So before I do a phone call, just to get a sense for who they are, look at 5 minutes of it because you can tell right away if they really know what they're talking about. And then you do a phone call with them. I'm really leery of promotion if they don't know. And this, I don't mean this in any way, but if I'm talking to a newer uranium company and they don't know who we are, then like we're one of my buddies Art and Adam at Segra, Guy at Tribeca, Marcelo down in Australia and also Brazil. If there's just a few of us that actually do this, the areas in Pennsylvania. Um, so if they're not familiar with the sector funds, right, and that happens sometimes, you're like, okay, well, then you really don't know the sector that you're doing it in. So, uh, and then it's really just a matter of understanding, looking at do they have technical report? Is an explorer? What's been going on in that area? Right? Have there been any discoveries? Was there a lot of drilling there? Has it been idle for a long time, that area? If there have been discoveries, where are they in those discoveries? Where are they located nearby those discoveries? Is there infrastructure nearby? There's a host of things you can look at. Uh, what's the in that area? What typically is the price that's needed to if they find something to get it out? But what's the history of that happening? Right. So we can go on and on and on and on that stuff. But a lot of it comes down to do I feel as though these people running this have a clue about the industry? Did they just pick up some BS projects to say they have a project? That to me, and do they have a history of doing okay? In other, they don't have. It's nothing wrong with with being new to the commodity. But if they have a history of making money for investors in other industries, and they in other commodities, and they've moved to a different one in a demonstrable track record, then okay, that's okay. Um, I I see more and more on when I see some of these shows, somebody will send me something and say, you got to see this one. And I'll look at it, and it's some management team trying to promote themselves. And you can tell they barely know the macro, whatever it may be. You'll start to see more of that. As the cycle works. Last cycle you had up to 500 companies, something like that, with uranium in their name or something to do with it. It was something to do with uranium. Now, I don't know, 70, 80, 90. I mean, we keep a list of everyone, new one that you see that's coming along. There are a lot more that are starting to come, and you're going to see a lot more, would be my guess. So, and then, right, you have to think about, Jesse, do you want exploration, you want development, or do you want production, right? How exploration is riskier, typically, right? Because you don't know if you're going to find anything. And so people need to understand that. I have friends who live locally to me who will invest in it, and I don't, and they'll ask me a question, and they think they own something, and it's not what they really think they own. So you have to know, in this landscape, explorer, developer, how much capital are they going to need? You need to think about that, right? Because when they're coming to you, a lot of the times, when they're out promoting themselves, typically what's up next? The capital raise, right? We're doing a non-deal roadshow. We're coming to visit. We're coming from Vancouver to come to New York. We're coming from Toronto. We're coming from wherever. We're coming from Australia. Just wanted to say hi. Got it. Right. It might not be this trip, but I know in the next 4 to 6 to 8 weeks, you're going to come knocking for money. And that's okay, right? One of the things I think I see a lot of is, well, they're going to dilute. Well, if you're owning an exploration company, of course they're going to dilute you. How? They don't generate revenue, right? A development company doesn't generate revenue. You just gotta be careful. The closer they get to cash needs, the more the promotion goes. And so it's step back. Don't get caught up in the promotion. Understand the geology, the infrastructure, the projects, all the stuff we just mentioned. But I don't subscribe to, just for me personally. There's always new things you're learning. There's things I take out of my toolbox mentally. There's things I add to my toolbox mentally.
Yeah, that's a great breakdown. I think the point is to do the proper due diligence. I think a lot of people just listen to the latest Rick Rule interview, and I've interviewed Rick. I love him. He's a wealth of knowledge, or somebody like that, and they'll just take a few of the names and throw their money at it without understanding truly what they're looking at. So I think that's some great words of wisdom there. What final question? I just wanted to touch on jurisdictional risk, because you mentioned you look at which area of the world it's in. Obviously, we saw jurisdictional risk come into play with the coup in Niger this year. So firstly, I'm wondering, how closely are you following the situation there? Do you think things will ultimately be resolved and it will go back to business as usual? And how do you personally mitigate jurisdictional risk when it comes to your portfolio? Do you just stay geographically diversified in case of events like this occurring?
Me personally, I, I said a few minutes ago, I look at the different geographies and the different geopolitical risks, and I uh, are there a couple of countries around the world that just throw something out? Yes, but where uranium mostly is, where it impacts my thinking is it's got to be, you got to, the risk I'm taking, the reward I could get has to be meaningfully higher than the risk, right? So, I mean, I have to. I'm not a geopolitical person. I read a lot. I always have. But what do I know? Like we talk to really smart people. We have access to on different things, and they inform us. But what do they know? That the different parts of the world, stuff changes very quickly sometimes. So I just have to think about that and say, okay, there might be a really great asset. It might be really cheap. I'm not talking any specific thing, but in anywhere like that where you have that type of strife that could occur, and turmoil and danger, uh, I need to demand an exceptionally high reward versus risk ratio. Um, I've got to really, really be disciplined in that and say, if I'm going to put some capital there, that's fine because the project may not have changed. The economics of the project might be really good, and I could appreciate that. But I could wake up one day and it's gone. I could wake up one day and it's nationalized. I'm not talking any specific things. These are in these tough neighborhoods where things can happen. Look at what's going on in copper right now. Right, stuff happens pretty quickly. So I need to know that the reward is much higher, and then I just how big do I want to make that, right? And like I said earlier, I, could I sleep losing X percent of my investment? If I can, then and a reward versus risk is great. Then yeah, I think, and that's why for reasons why just being a registered vehicle or strategy, being a registered strategy is the way you have to refer to it. I can't talk specifics about things, but you don't know, right? One of the people promote a name company, they talk about it, what they like. I don't know that the person on the other side, they might go out and make that their only position and make it really big, and that's horrifying. That's terrible. So I don't know. So I don't want to do that, right? Because it's about position sizing. It's about do people want to have a 1% position, a 2%, a 15%, a 20%, right? Really concentrated, diversified, and a lot of that comes from what sits in here. What makes you want to throw up? How much can you afford to lose? Right? If you are investing in this sector, I mean, it is mining, and then you're into junior mining. It is tough. It is hard, right? I mean, I think the risk reward is exceptional. It's the best risk reward I've ever seen. I've been saying it since 2018, and I keep saying it. I still think that, but it's tough. It's hard. It's volatile. It's in tough parts of the world. You got to size accordingly. So I don't, what's going on this year. I I pay close attention to it. How it all plays out, I don't know. What I do always notice is that with all of these situations, whether it is year or pick other stuff, is when things happen, all of a sudden, everyone's an expert on it, and people who have no expertise on it. Right. So, but all of a sudden everyone has an opinion and people arguing back and forth like Twitter and going back and forth. Like, you mean you read the newspaper yesterday and now you're an expert on what's going on in this year, or like, come on. So, I just don't, there's so much that I don't know, right? I know way more that I don't know than what I do know. So all I can focus on is what I do know. And in my little tiny little world, how does that impact it? And, when it comes to making those big sweeping calls like that, you just size accordingly.
Well, Mike, this has been an extremely enlightening conversation. I learned a ton, and I'm sure the viewers and listeners will as well. So thank you so much for joining us again. I know you don't do a lot of these. I think this one was exceptional. I think people are going to get a lot out of it. So thank you so much for coming back on the show.
My pleasure, Jesse. Thanks, buddy. Thank you.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get $10 off your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.